Friends, Bhupesh Anand again. Lecture number 5. Today we will start with. We have covered some basic concepts in mutual fund in last 4 lectures. We are doing securities laws and capital market, and I have told you that practice makes the man perfect. Practice makes the woman also perfect, and action speaks louder than words. So today I will be starting with the main basic logics again of mutual fund, and I will be covering 5 parts, 5 subheads, 5 concepts. So please take out your registers, please take out your books as well, because I will be discussing something from book as well as you have to write down some slides. So please write down lecture number 5, great morning, mutual funds, and lecture number 5 is be happy, be jolly, be cheerful. So to my dear friends, I have already delivered 4 lectures. In lecture number 1, I discussed about need and necessity of mutual fund. That why there is a need of mutual fund. Why this fund concept has been evolved in from America. Flow chart. Then in lecture number 2, I discussed about the flow chart. That what are the steps, what is the meaning, what is the introduction, what is the objective of a mutual fund, and what are the 4 questions which we have to answer. Then the third lecture I have started with I have taken the structure, that what is the structure of a mutual fund, who are sponsors, who are asset management company, who are trustees, what are the process, what is the process of that, who are market intermediaries, custodian, depositories, and transfer agents. Even I have shown you some website also. In lecture number 4, that is in the last lecture, I told you about advantages, about the cost related with mutual funds, and the risk involved in mutual funds. So today I will be starting with 5 major concepts, and those concepts are very important. So my major concepts will be, firstly I will be starting with types of mutual fund. That what is the meaning of a mutual, what are the different types of mutual funds. No doubt I have told you in one lecture some brief idea, but I will discuss in detail the types of mutual fund. And then second part which I will be discussing will be that what are the schemes available in mutual fund, what are the different types of schemes, what are the different types of mutual funds as per different investment objectives. So please take out your register, my dear. First, write down these things. Types of mutual funds. A part we will be covering today. Schemes of mutual fund as per investment objectives, as per investors' objective. And then third part, today we'll be starting with what are the strategies which are being followed by AMC or the fund manager or the CIO while investing the fund, the corpus. Investment strategies being followed by AMC. This will be third part. It means I can also number it. We have discussed, I have taken concept number 13, 12, 13, 14. So this will be concept number 15th, I suppose concept number 16th, and this will be concept number 17th, concept number 18th, and concept number 19th. So today I will be starting with, I will be dealing with these 5 concepts. And concept number 17, I will be telling you about investment strategies. Concept number 8 and 18th, rollover of a scheme. It means whether a close-ended fund can roll over, can postpone the redemptions, can roll over the scheme to next years also. Yes. And the last concept will be whether an investor can switch over one scheme to another scheme. So these will be the 5 parts which I will be dealing today. And first part will be, I no doubt I have written in my, in my all I will say, in my book also, I have shown you so many things like this. Just have a look on my book. I'm just taking out the this is my first concept, but I want to show you this question number, this is question number 3, this is question number 3, and that is distinguish between open-ended mutual funds and closed-ended mutual funds. This is my today's first concept of lecture number 5, that what are the different types of mutual funds available. My dear sir, there are 2 types of mutual funds as per the structure. No doubt I can bifurcate my mutual fund on the different categories on the basis of portfolio, on the basis of asset classification on the basis of structure, but I am not telling you that detailed version. I will be telling you that there are two types of mutual funds as per the structure, or I will say two types of basic mutual funds. One is open-ended and second is close-ended. So I will be discussing with open-ended and close-ended. I have given you huge, information in regard to open-ended and close-ended. But again, I will be requesting you that you have to write down some slides because those slides have a different language, a very very easy language, different examples which I have not given in my book. So when I say an open-ended mutual fund, what do you mean by that? What do you understand by the name open-ended mutual fund? The open-ended mutual fund means the fund which is open, which is never closed. It is always open, just like a cafeteria in a five-star hotel. You can go at any time. You can go at any time and you can enjoy that cup of coffee at any time. That is 24 by 7, 365 days. So that cafeteria is always open. Similarly, a mutual fund AMC is always open. You can directly go to the mutual fund AMC. You can directly buy the units on the basis of the NAV. You can directly redeem the units. Huge liquidity is there. Directly you can transact with asset management company, with the fund manager. There is no need to go in exchange. That type of fund where huge liquidity is there, that is named as open-ended mutual funds. And if I contrast, if I take the opposite of open-ended fund, I will be available with close-ended mutual funds. It means those funds which are open for a particular time period and then they will be closed. It means you cannot redeem it. There is a lock-in period. That unit holder cannot directly go to that AMC within that period for redeeming it. There's a lock-in period involved in that. It means if anyone wants to sell close-ended mutual fund units, then that person, that investor can directly go to the exchange, and with help of exchange, they can sell or buy the units of close-ended mutual funds. So there are two types of mutual funds by structure, my dear sir. One is open-ended and second is close-ended. Please take out your registers. I am again requesting you have to write down all the slides. Types of mutual funds on the basis of structure. This is my concept number 15. Open-ended and close-ended. When I say open-ended is a fund. That is a fund, that is a mutual fund which is available for subscription all throughout the year. Which is available for subscription throughout the year. Which is available for subscription throughout the year. It means every period of time that is available. That is named as open-ended mutual fund. So please write down, open-ended mutual fund is a fund that is available for subscription all throughout the year. These do not have fixed maturity. It means because there is no lock-in period, so there is no fixed maturity as well. In this case, there is no fixed maturity. Those funds which are freely available, you can directly go to the AMC, you can buy it on the basis of net asset value. Those are named as open-ended mutual funds. Third is, the key feature is liquidity. The key feature is liquidity. That is most important. So please write down open-ended. I'm giving you some time. It is a fund that is available for subscription all throughout the year. These do not have any fixed maturity. Key feature is liquidity. Key feature is liquidity. Even I can Google it and I can find out the difference between open-ended and close-ended mutual funds. This I have just put a question. A close-ended is a fixed number of shares offered by investment company through an initial public offering. It means in a close-ended, the units will be issued at the time of initial fund offer, initial public offer for that particular period. So if you want to purchase it, you have to go in that period only. Open-ended are offered through a fund company that sells shares directly to the investor. So this is the main difference between open-ended and close-ended. Even Investopedia is very good for explaining that. Wikipedia and Investopedia are very very good sites, very knowledge We can gain knowledge from this close-ended and open-ended. Close-ended and open-ended investments have basic characteristics in common. Both are professionally managed funds that achieve diversification. This. Okay, I want the difference between these two, and the difference is okay. So I can also see from here, what is the difference between open-ended and close-ended. So Investopedia and Wikipedia. So please write down something for close-ended. Investor can buy and sell units at NAV related prices. This is the fourth point for open-ended. Investors can buy or investors can sell units at NAV related prices. It means I can buy or I can sell my units on the basis of net asset value, which is appearing, which is existing at that particular point of time. So this is my open-ended. But when I say close-ended, it is just opposite to open-ended. So please write down, this fund is open for subscription only during specified period. Only particular period this offer is being open when there is a case of initial public offering. So write on first point, this fund is open for subscription only during a particular period. It means you want to go for a cafe, in CCD, Cafe Coffee Day, or in your barista, you can only enjoy that coffee in that particular office hours. You cannot enjoy, after office hours. Just like in a cafeteria in 7-star hotel, that is open-ended. But in close-ended, in barista, in particular timing only you can enjoy a cup of coffee in barista or Cafe Coffee Day. So that is named as close-ended, and that will be named as, that cafeteria in 5-star is named as open-ended. So please write down close-ended fund. This fund is open for subscription only during specified periods. Second point, investors can invest in a scheme. Investors, it means common man, the middleman, those persons who are doing savings, they want to invest something, those investors can invest in a scheme at the time of initial public issue, and thereafter they can buy or sell, not through AMC, not through asset management company, not through that company, but they have to buy and sell through exchange where that mutual fund is listed. So this is very important. This is the main difference between closed-ended and open-ended. And the next point which is there is, I will be coming to schemes of mutual fund, but before that, I want to show you from my book that what is the differences which I have written in my book. The first point is meaning. Open-ended, open-ended can be understand as a scheme that offer you to the on a continuous basis. So this word is very important, on a continuous basis. But close-ended is that which offers only for a limited period, limited period, only for a limited period. So I have given, whenever in the examination question is being asked, what the difference between this and this, it is better to give the presentation on table form. The secret behind my success is in the examination, I cleared CA, I cleared CS, I cleared CMA, I cleared so many papers of America, London, Europe, because I usually give the difference between the tabular form. I used to prepare flowcharts. I used to give the examples. So that is the main reason behind my success. So in this question number 3 in my book, I have given the presentation of tabular form. So first is the meaning, the difference of meaning of open-ended and meaning of closed-ended. Subscription. These funds are available throughout the year for subscription. These funds are only available during specified days. You can only get for specified days throughout the year. So these are the keywords which you have to highlight. Please use your highlighter and highlight these keywords. Maturity. There is no fixed maturity in case of open-ended, but there is a fixed maturity in case of 3 to 5 years in case of close-ended. That's why there is a concept of rollover. I will be telling you today that what I mean by rollover of a mutual fund, of a closed-ended mutual fund. So these are the difference between open-ended and closed-ended. The liquidity is fund itself, a stock market. If liquidity provider, in case of open-ended, you can directly go to the AMC. So fund itself is a liquidity, providing liquidity, but in case of close-ended, they will be traded in stock market. The stock market is is being named as a liquidity provider. So these are the differences. Corpus is variable, corpus is fixed. When I say close-ended, everything is closed. Now that corpus is fixed, but in case of open-ended, that corpus is variable. So these are the main differences. So let's start with the next point. Today I will be discussing with 5 concepts. The first concept I have already discussed. Now the most important concept which I will be telling you is scheme of mutual funds, or what are the different types of schemes available as per investment objective. Very important, very important, that what are those schemes which are available by mutual funds as per the objective, as per the investment objective. For example, just have a look on this. Just have a look on HDFC mutual fund schemes. HDFC retirement fund, HDFC equity plan, HDFC retirement saving fund, equity plan, regular growth, the direct plan growth. Just see how many types of different types of schemes available in case of HDFC. Similarly is the case with Reliance. Just have a look on this Reliance also, now named as Nippon. Let us see the point customer services and then annual reports. I'm directly showing you live that how I can, then financial year 18-19, then I can go upgrade scheme, what are the different types of schemes available as per Reliance. Just have a look on this. Just have a look on this. Reliance Growth, Reliance Vision, Reliance Power, Reliance Multi-Cap, Reliance this, Reliance Focus, Reliance Large Cap, Reliance Value. Huge schemes are available. It means I will be doing today what are the different types of schemes available in a mutual fund. Now it depends upon the objective of an investor, that what he wants to invest. What is his objective? It is just like a menu card in a restaurant. When you go in a restaurant, there are in the menu card there are so many things available. Starters are there, then main course is there, then sweets are there, then drinks are there, soups are there, salads are there, but it depends upon your taste, upon how much you are feeling hunger, and how much is your budget. So accordingly you order it. It means every person can have a different type of objective. If I compare two persons, one is Mr. A, who is 21 years of age, who is a qualified professional, and one Mr. B, who is 60 years of age, who has just obtained his retirement. Now, these two persons can have different types of objectives, and they have different types of risk appetite. For example, if I say of Mr. A, who is 21 years of age, he is ready to take risk. He is not married up to this date, so he can enter into long-run strategies or more return strategies, more risky strategies. So in that case, he will be going with a separate investment objective. If I compare Mr. B, who is 60 years of age, and his children must be of 20 to 25 years of age, because he must have married at the age of 25 or to 30, and after 1 or 2 years, then his children will be of this age scale. So he has a huge requirement of funds. So, and he cannot take any risk. Mr. B, who is 60 years of age, so he can have a different investment objective. Similarly, Mr. C, who is 40 years of age, he may be having different types of investment objective as compared to Mr. A and B. So my dear friends, what I want to say you, that it depends upon the objective of the investor, that in which type of scheme he wants to invest. So today's lecture, today's concept, which I want to start with is, the name is Schemes of Mutual Fund as per Investment Objective. What are the different schemes available as per investment objective? So right now, there are numerous schemes as available for investment as per the investment objective. I have given you huge schemes, and I have just shown you on live also that HDFC mutual fund schemes are there. Similarly, I have given in my book also that there are different types of schemes. Question number 11. What are the different types of schemes available as per the investment objective? No doubt, I have given the huge list of these schemes. But my dear friends, you have to write down some slides so that you can better understand that. So let's start writing something. First scheme which I have given is named as Growth Fund for Mr. A, who is 21 years of age, who can take huge risk because his expectation is high return. So risk and return. Growth fund schemes. These types of mutual fund schemes, they they predominantly, they invest in, the corpus is invested in equities, in purchasing the equities of the companies. Equities, because they have the huge risk and the huge growth opportunities also there. Because risk and return has a direct relationship. Risk and return has a direct relationship. More will be the risk, more will be the return. So please write down first point, growth mutual fund schemes. Growth mutual fund schemes, in which I want that my capital appreciation should be there. If I have purchased a unit at rupees 10 and after some particular period, this should grow up to 10x. So that expectation of capital appreciation is named as growth. So those investors who have the objective to grow their units, their fund value, they go in growth schemes. So write down growth funds or schemes. These schemes invest a major part of corpus. These schemes invest a major part of corpus in equities, because there is the growth opportunities in equities and nowhere else. So these types of funds who are named as growth schemes, growth funds, they majorly invest their corpus in equities. The aim of growth fund is to provide capital appreciation. I have just told you, an investor who has purchased one unit at rupees 10, he wants that after a particular period, the value of this unit should be 10x. So he wants the capital appreciation from that. So the main objective who wants to invest in these types of funds is capital appreciation. So right on second point, the aim of growth fund is to provide capital appreciation. The aim of growth fund, the aim of growth fund is to provide capital appreciation to the investors. The aim of growth fund is to provide capital appreciation to the investors. The next type of mutual fund or next scheme of mutual fund, as per the investor's objective is, I have written income fund or regular income scheme. If Mr. B, if I think of Mr. B who is 60 years of age, his main objective will not be to take high risk, rather low risk, but a regular income. So Mr. B should invest in a fund named as income fund, because regular income will be coming here from here. And these types of funds, the aims of this company, of this fund, they will be investing the corpus in fixed income securities, bonds, debentures, from where regular income can be recovered, can be earned. So please write down, the aim is to provide regular and steady income to the investors. So the main objective in this type of scheme is to provide regular income to the investors, as compared to growth. In that growth, the main objective is to provide the value appreciation. But in case of income fund, the main objective is to provide the regular income. So it depends upon the risk appetite of that investor, that what is his objective. So please write down, the aim is to provide regular and steady income to the investors. Such schemes generally invest in fixed income securities, those securities which will give fixed income. Equity is a non-fixed income security. Debenture, bond is a fixed income security, because you can predict that this much will be the income you will be getting from these types of investments. So in case of income fund, the mutual fund will be investing in fixed income securities. So I have discussed two. First scheme is growth scheme, second scheme is income scheme. Third scheme which I am going to start with is named as hybrid scheme. Hybrid, when I say hybrid, it is a mixture of two, mixture of fixed income as well as mixture of non-fixed income securities. I will say mixture of investing in debt, in bonds, as well as investing in equity securities. So that mixture, that will be good for that particular person, Mr. C, who is 40 years of age, cannot take huge risk as compared to Mr. A, or he is not interested in the low risk as compared to Mr. B. So he is in middle of these two. So that is named as balance scheme or hybrid scheme, which is a mixture of two. So please write down hybrid scheme. The aim is to provide both. The aim is to provide both growth. The aim is to provide both growth and regular income to the investors. The aim is to provide both growth and regular income to the investors. And regular income to the investors. Investment targets of these mutual funds is a mixture of bond. It means they will be investing both in both. One is bonds, fixed income as well as non-fixed income. Fixed income securities as well as non-fixed income securities. So I have discussed three types of schemes. One is growth scheme, second is income scheme, third is hybrid scheme. There are hundreds of schemes available, but I will be discussing with you the basic scheme so that you can get an idea, of what are different types of schemes available. Next is money market scheme. If as an investor your objective is you want to have a safety in your principal amount. You want very huge liquidity. You are not interested in high income, low risk, low return is okay, but you want to safeguard your principal amount. So in that case, those types of funds are named as money market mutual funds. So fourth point is money market mutual funds. These schemes invest in safer short-term instruments, just like treasury bills, certificate of deposits, commercial paper. These are short-term instruments, money market instruments. So my dear friend, money market fund scheme is to safeguard your principal amount irrespective of low return and low risk. So you must have written this. These schemes invest in safer short-term instruments. The objective is to provide liquidity, preservation of capital. The objective of money market is to provide liquidity, to provide preservation of capital and moderate income. So next type of fund which I am going to start with is gilt funds. Those mutual funds who will invest in the government securities. So if as an investor you have the objective that you want to invest in government securities, so you should purchase units of gilt mutual funds, because those gilt mutual funds, they will be investing their corpus into government securities by buying government securities and selling government securities. And generally, the NAV, the net asset value of that fund changes because of change in the economic policies, change in the interest rates, change in the inflation rate. So these can be the major, determining factors of NAV. To just have a look on this. These funds invest in government securities. Gilt funds invest in government securities. NAV fluctuate due to changes in. NAV means net asset value of that fund. Please write it down, my dear friends. Please write it down. Net asset value fluctuates on interest rates, inflation rate, or some changes in the economic factors, GDP, growth income, economic growth, per capita income. Next fund which I am going to start with is exchange traded funds. You have to write down, if as an investor I am mainly looking for the liquidity, I want that these units, the units of this mutual fund should be traded in an exchange. So I will go for exchange traded funds, because there are some units which are not traded in a recognized stock exchange. So exchange traded fund means those units, those types of funds whose units will be easily traded in the market, in the stock market. So write down 6 point, exchange traded fund. They are traded in stock exchange, which makes them more liquid as compared to other funds. As compared to other funds. So these are named as ETF, exchange traded funds, as the name indicates. The next is fund of funds. As per this scheme, the mutual fund is not investing directly in the securities. Rather, this mutual fund X is investing in mutual fund Y. The schemes of mutual fund Y. And Y is investing in securities. It means I am not directly purchasing the securities. I am investing in those mutual funds who are purchasing those securities. So this is named as fund of fund, a new concept which has been evolved from America. In India, it is not so much prevalent, but for examination, it is important. So please write down fund of funds. It is a mutual fund which invests in the scheme of other mutual fund. It is a mutual fund which invests in the schemes of other mutual fund. So that is named as fund of funds. Instead of investing in securities, it means I am not directly investing in these securities. I will be investing in those schemes of those mutual funds who are investing in securities. So this is named a fund of fund. Such funds are not prevalent, operate at present in India. Okay, hedge funds. My dear friends, the next category which I am going to start with is hedge funds. Those funds, those mutual fund schemes which are generally for speculative purpose. They are buying undervalued shares because they, as per them, these shares are undervalued. So they are buying it so that they can sell in the future at higher rate, and they are selling the overvalued shares. I repeat, some shares they may be undervalued at this particular time, so they are buying undervalued shares. For example, MRF Tire share is undervalued as per this mutual fund X. So they are buying MRF tires because they know, they predict that in future the value of this share of MRF Tire will increase. So with the intention to have speculative profit in that. So they are buying MRF tires, and supposedly as per them, Apollo tires is overpriced. So they are selling over Apollo tire script because they know that, they predict that, they think that in future the price of Apollo tire will fall down. So two concepts I have gathered from here. One is buying undervalued shares and selling overvalued shares with the option, with the intention to earn speculative profit. Those are named as hedge funds. Those are named as hedge funds. And the next fund which I want to start with is that is named as tax saving schemes. Tax saving schemes. It means if as an investor you want to get a tax rebate from income tax, you want to save your tax, in that case you have to invest in those equity linked saving schemes or in those pension schemes which are being notified time to time that if you invest in this for this much period in this mutual fund, you will be getting the rebate in income tax. So those funds, those schemes, that objective is named as tax saving mutual fund objective. So write down 9th point, tax saving schemes. These schemes offer tax rebates. These schemes offer tax rebates to the investors under income tax laws. These schemes offer tax rebates. These schemes offer tax rebates to the investors under income tax law. Government offers incentives on different types of schemes. I have just written two: equity linked saving scheme or in pension scheme. So these types of different schemes are being notified from time to time by the government. In that, if you invest, so if I buy the units of those mutual fund units who are investing in tax saving schemes, then that is named as a tax saving scheme mutual fund. So we have discussed, first is growth mutual fund we have discussed, second is income mutual fund, then I discussed with money market mutual fund, then I discussed with hybrid mutual fund, then I have discussed with gilt mutual fund, then exchange traded mutual fund, then funds of fund, and now I have discussed tax saving mutual fund. Let's start with the journey. The next is eighth one is new direction funds. As per new direction, I want to say that these types of funds, they invest their corpus in the new fields. For example, when I say pollution and how to control that pollution schemes, or I can say the new innovations in birth control or anti-pollution. So these types of schemes are, when they invest, that is named as new direction fund schemes. So these funds invest in scientific and technological research such as birth control, anti-pollution, etc. Real estate funds. Because I have limited amount, I cannot directly buy that real estate because that real estate is very costly. So but I think that the price of real estate will increase. So instead of directly buying real estate, I will be opting that scheme, which is aimed as real estate mutual fund scheme. I will be buying the units of that mutual fund, and that real estate mutual fund instead will be buying those real estates physically, with the thought process that the price of this real estate will increase in future. So that is named as real estate funds. Please write down. These funds invest predominantly. These funds invest predominantly. These funds invest predominantly in real estate properties. In real estate properties. So like this, I have discussed, different types of schemes. No doubt, I have given the huge list that what are the different types of schemes available in case of a mutual fund. I cannot, there are hundreds of schemes available, but I have discussed the basic schemes. Rest you can see from the book. I have given for at least some part, some content for that. So I am moving to next concept. We have discussed two concepts. One is what are the types of mutual funds, and second is what are the different schemes available of mutual fund. This is step number 2, question number 2 as per my flow chart. So today I will be starting with now the next concept, that is investment strategies. What are the different types of strategies which can be followed by AMC or by a mutual fund? There are 7 to 8 strategies which are being generally followed by a mutual fund. That is again a very important and a very key question for the examiner. But what are the different types of strategies which are being followed? So I have written first strategy is bottom up investing. Bottom up investing. I will be telling you what is the meaning of bottom up investing. Top down investing. Aggressive strategy, defensive strategy, balanced strategy, sector strategy, all different types of strategies can be adopted by AMC. So I will be watching these investment strategies. First is bottom up investing strategy. Second is top down investment strategy. Third is aggressive strategy. Now what is the meaning of bottom up strategy? Supposingly you want to invest, then firstly whether you will be watching towards, whether you will be analyzing towards economy, then industry, then to a company, or firstly you will be taking focus on company, then industry, and then to economy. No, these are two approaches which I have told you. The actual approach should be that if you are a fund manager of a mutual fund, now you want to invest either in Indian economy or in Pakistan economy, either in India or in Pakistan. So you firstly compare the Indian economy with Pakistan economy. It means GDP, it means per capita income, it means economic growth, and then you compare it with Pakistan. Supposedly you have decided that India is the best economy to invest in. Now within India, there are so many sectors. Auto sector is there, IT sector is there, FMCG sector is there, paper sector is there, oil and gas is there, banking sector is there. Now you have to decide the sector. Supposing you have decided IT as a sector, information technology. It means you did economic analysis, then you did industry analysis, and within that industry, within that IT sector, which company is better? Now you are analyzing Infosys versus Wipro versus TCS, and you have selected Infosys as a security. Now the point is, you did economic analysis, then you did industry analysis, then you did company analysis. So this is named as top down approach. I repeat, top down approach. Top down approach, because you have started from beginning to end. Or I will say it is just like a arranged marriage. Arranged marriage. When I say arranged marriage, a girl and a boy has not so, no doubt they are important, but we are giving more importance to their parents, to their grandparents. So when we are looking from grandparents, then parents, and then to a boy, then I will say it is an arranged marriage. And when I see a love marriage, we are mainly focused on the girl. The boy is only focused on the girl, and the girl is only focused on the boy. They are least concerned about parents, about grandparents. You have seen that Welcome movie. In that, Katrina Kaif was there, and Akshay Kumar. Akshay Kumar is only watching that Katrina Kaif, not interested in Katrina Kaif's brother, what are they doing? He's least concerned with that. So I will say there are two types of strategies. Rather, there are 7 types of strategies. One is bottom up. Bottom up investing strategy means when you firstly put the emphasis on company, then on industry, then on economy. It means this is love marriage. You want to invest in Infosys. Then IT sector analysis you did, then you did economic analysis. But when you firstly did economic analysis, then industry, then company, it is named as top-down approach. So there are 2 approaches. One is bottom-up and second is top-down. Aggressive strategy means when we are ready to take high risk, that is named as aggressive strategy. It means maximum of the corpus is being invested in. equity securities, because then only you will be getting aggressive. Aggressive means risky securities. And when I say defensive or conservative, it means I am not interested in risk. I am risk allergic. In aggressive, I am a risk lover, and in defensive, I am risk allergic. You are getting the difference between these two. Balanced, and then sector, and then short term. So bottom up investing, it is like a love marriage. You have seen the Welcome movie. In that I have given what is the meaning of economy. Firstly, we are seeing economy, then industry, then company. So this type of approach is named as top down. But firstly, if I am putting more emphasis on a company, then on industry, and then to economy, this is named as bottom up. So there can be different types of strategies which an AMC can follow. Top down, firstly economy, then to industry, then to company. It is like a arranged marriage. It is like a arranged marriage. Paresh Rawal is following top down approach. That one character is Paresh Rawal. You know that person name, actual name is Paresh Rawal. He's not putting more emphasis on Katrina Kaif. Rather, her brothers and ancestors. So next point, next concept which I will start with is rollover of a scheme. Now again, this rollover is not covered in my book, so you have to write down the full slide. Even the next concept, that whether an investor can switch over from one scheme to another, you have to write it down, my dear friends. Rollover of a scheme. When I say a rollover, and when I say rollover, and when I say there are two types of funds, I've just told you, one is open-ended, and second is close-ended. When I say close-ended, it means I cannot redeem those units up to that particular period. Supposingly, the period is 5 years. It means those units cannot be redeemed up to 5 years. This will be named as close-ended mutual fund. Supposingly, after 5 years, AMC is of the view that they want to continue, they want to get more 5 years, because as per them, now again a new opportunity is coming. So whether this scheme can be rolled over for next 5 years. Now this concept we will be discussing, that whether I can roll over this scheme or not. The answer is yes, it can be rolled over, but subject to terms and conditions. It means that mutual fund has to fulfill some terms and conditions. Then only that scheme can be rolled over. So let's see what are those conditions as per which a scheme can be rolled over. First point, a mutual fund can roll over. A mutual fund can roll over a close-ended scheme. A mutual fund can roll over a close-ended scheme on or before the redemption of the scheme. I repeat, a mutual fund. I am talking of a close-ended mutual fund because this point will be relevant for close-ended mutual fund. A mutual fund can roll over a close-ended scheme on or before the redemption of the scheme. It means either prior to 5 years or on exactly 5 years, you can roll over. After giving, but the conditions are after giving an option to the investors that if they want to continue with us, they can, or if they want to exit, they want to redeem their units, they can redeem their units as well. So after giving an option to the investors to redeem their units at NAV, net asset value based prices, it means the NAV which is appearing at that particular moment, that NAV will be offered to them. So it is upon to them, it is their option that whether they want to redeem it or whether they want to continue for next 5 years. This is named as rollover of a close-ended mutual fund. So as per legal matters, it can, but it can only subject to some terms and conditions. Rollover means fresh extension of period. It means originally the period was 5 years. Again, I want 5 years. So this is rollover. Rollover. Rollover means fresh extension of period under the same terms. Same terms of the original scheme with or without modifications. Please write down third point. Rollover means fresh extension. Rollover means fresh extension of period under the same terms of the original scheme with or without modifications. So that I mean by rollover. So the last concept of today's lecture will be that whether an investor can switch from growth to income scheme or from income to growth scheme. Yes, but again it is a discretion of that mutual fund, that whether that mutual fund is allowing it or not. So please write down this point also. This is also not covered in my book. Switch over one scheme to another. A mutual fund, it means I am talking it from investor point of view, that whether an investor can switch over the scheme. A mutual fund may use its discretion to permit switching over. It means it depends upon the mutual fund that whether that mutual fund is allowing it or not. A mutual fund may use its discretion to permit switching over of the investment from one to another scheme. It means it is not mandatory for the mutual fund that they have to allow. Now it depends upon the discretion. But investor can do it if mutual fund allows it. From high risky to low risky to high risky schemes can be switched over to help investors shift from high risk scheme to a low risk scheme or vice versa. So today, my dear friends, I have discussed 5 different types of concept. First is types of mutual funds. Then second is what are the different schemes of mutual fund. And then what are the different investment strategies of AMC. And then whether a rollover of scheme can be possible for close-ended fund. And at last, I discuss about from investors' perspective that whether that the scheme can be switched over. So with these, I have discussed the basic concepts. From next lecture number 6, I will be discussing the practical part. I will be doing huge practical questions. So please revise all these 5 concepts, 5 lectures before watching that lecture number 6. Be happy, be jolly, be cheerful.